Welcome back. We're joined by Karen Sullivan again, who's going to help us once again with debt. Karen, thank you very much for joining us again.
Thank you for having me.
That's cool. Now, Fred and John we're going to be talking about.
Ah, yes.
Now, we've had a quick chat about John. Should we deal with John first? Now, you're a mortgage broker, and there's legislation seriously about what you can and can't talk about. But that's in an advice situation. We're here, I think, in a media situation. So if you feel able to give us a personal view, that would be really good as well. Okay.
Great.
Can we start with John? You thought that he mightn't have been able to qualify for the loans. Can you tell us a little bit about that?
Well, initially, when I looked at his debt levels against the actual amount of equity he has, it would appear that he's borrowed at a much higher gearing ratio than what the banks would normally allow. He certainly has loans that would need to be mortgage insured if he were borrowing those today, and the mortgage insurers really, he would be at their absolute limit, so it wouldn't have been very easy for him to have qualified for that. And being that he actually has a negative cash flow situation, I actually don't see how he would have qualified. Possibly though, you know, in the last couple of years property values have dropped a bit. Perhaps when he bought his house the ratio wasn't so high. So certainly in today's market he would struggle to get that finance.
Well, that's true, but looking at Fred and John are really figments of my imagination. He is a mortgage broker, and he leveraged that connection to get the loans. I think the LVRs being 80 and 100% say the property values haven't changed. So I suspect he's had somebody's arm up behind their back to give him the loans. Now, the next thing is, we had a chat about his car. And you were surprised that he would even get a lease for the car.
Well, that's right, because under the current legislation, we really have to prove that someone is not going to be put into hardship by providing them with this finance. So being that he's in such a negative cash flow position, someone has overlooked something or not been told something in order for him to be able to qualify for that.
Well, as I say, he got a very good relationship with his Porsche dealer.
And he's a merchant banker himself, so he probably knows what he can say and what he should hide.
Well, that's true, and of course we shouldn't hide anything because it can come back and bite you.
Oh, absolutely. Certainly with my clients, if they tell me that their expenses per month are double what the banks would expect them to be, I have to declare that to the bank, because it means they have to change their lifestyle if they're borrowing to the maximum of their ability. And when you force someone to change their lifestyle, that's not a comfortable position. So I would always have the conversation with my client before submitting the application to say, well, look, your expenses seem a little bit high. Is that because you have a lot of discretionary spending, or, you know, would you cut back your holiday if you found next year you couldn't really afford it? Or is this something you need to have because you're so stressed with work you have to get away with for a period of time each year? Because really, if someone's not going to be happy once their lifestyle has changed, then maybe they would prefer not to be buying the property they're buying.
That's right. And we've spoken before about good debt and bad debt, and the thing we've been trying to communicate is that deductible debt is good and non-deductible debt is bad. But we also managed to say that irrespective of how well structured the debt was, if you couldn't pay for it, it was terrible debt.
Absolutely.
Because it's going to cost you your assets.
Because even deductible debt, you're only getting back the percentage that you're being taxed at. So for every dollar you're spending, you're getting, you know, 30, 40, 50 cents back as a maximum. So...
assuming it's 100% geared.
Correct.
Yeah.
Correct. So they've got to be able to afford that difference in the meantime.
Negative gearing is a misconstrued term to my mind. It's seen as a great advantage. But what it actually means is that if you make a loss on property, you get a tax deduction.
That's correct.
If you don't make a loss on property, you don't get a tax deduction.
So basically the government's saying if you make a loss, we'll give you a little bit of it back.
Yes, but only a little bit.
I'd like that to happen in my business. If I make a loss, will they give me some of that back?
Now, let's talk a little bit about Fred. What can you tell us about Fred and his loans and how he can build on what he's got? And
Fred seems to have taken quite a conservative approach when he was borrowing money. He's waited until his home was paid off before going to borrow more money to invest with, which is quite a comfortable way for him to have structured things. And certainly the banks would see him as a top class client. They would be fighting for his business. They'd be prepared to give him perhaps lower rates or cheaper fees to try and get his business.
we've spoken about LVR before in the show and explained it, but can you give us a mortgage broker's interpretation of what an LVR is?
Certainly. It actually stands for loan to value ratio, but it's actually a percentage. So when you divide the amount of the loan by the property value, you come up with a percentage that is your total borrowings.
Okay, cool. So we've already said John's LVR is 87, coming up to 90, whereas Fred's probably around 25, 27%. It's a very comfortable situation to borrow from, isn't it?
Absolutely. At 25%, he's a very low risk client, because even in the event that something went drastically wrong, if he lost his job and his tenant defaulted and he really couldn't pay things back, if the bank was to repossess his properties, they're assured of getting their money back. Whereas Fred, on the other hand, by the time he's defaulted on interest for a period of time and the loan is sitting at a much higher balance than it should be, then you've got the legal fees to get him out of there and the agent's fees to sell it. Plus then you're probably going to sell it quickly and not necessarily for the top value you could get if it was marketed over a longer period or if you spent more money on marketing. So the chance of the bank not actually recovering their loss is quite high.
Which is why they only lend to 80%.
Without mortgage insurance.
Yeah, exactly, yeah.
But that's where mortgage insurance comes in, that the mortgage insurance company protects the bank against their loss.
Yes, not
There's
the
no
individual.
protection for the client, not at all. But at least the banks then are prepared to lend at those higher ratios because they know that in the event of hardship or having to sell up this client, that they will still get their money back.
In terms of cross-collateralisation, we spoke earlier about John and the way he's cross-collateralised his debt. Even though he's a merchant banker and he thought he was smart, that'll cause him a problem when he gets his affair in orders and wants to buy another property, won't it?
Absolutely. If he, over time, creates some more equity in his property, and perhaps then his loans might be below the 80% level, if he then wants to borrow a little bit extra to pay a deposit to go and buy something else, and that extra amount takes him over the 80% again,
As it probably
he'll then
would,
have
yeah.
to pay mortgage insurance on the total amount of borrowings.
Okay, so he owns property, he's got debt of, what, 2 million?
Yes,
So he'd actually pay mortgage insurance on 2 million rather than on the 500,000 that property he was buying or something like this.
correct.
And that's a percentage of the total borrowing, so it can amount to quite a bit of money.
That's right.
Have you any comment in relation to these two about how they might improve their situations? This might be out of the remit of a mortgage broker, but as a private individual, what could you offer them any advice?
Well, the advice for Fred would be that he's got equity there that he's really not using to the best of his ability, and if he's wanting to retire early, then really he should talk to an advisor about perhaps using some of that equity effectively to create more income for himself or to, over time, get some capital growth happening. So with John, on the other hand, he needs to get his spending under control. He has a really negative cash flow there, and if he continues on that path, then he's going to have serious issues. So we would need to discuss whether there's been a change of circumstance that's created this negative cash flow situation, perhaps with things having gone a little bit slow in finance industries in the last couple of years, perhaps he's not earning as much as he used to, but he really needs to cut his spending. So I would probably suggest selling the car. And because he certainly can't borrow against his house to pay out that loan and spread the payments over a longer term.
No worries, thank you very much, Karen. It's lovely for you to join us again.
Thank you.
I hope Karen's clarified some issues around debt for you. And if you have any questions, of course, go to the blog as usual. We'll see you after the break.